Then I've got quite a number of slides on some current issues in tax involving the cases and things like that. Now, for the interest of time, I've decided that for this one, there's no point for me to explain to you in detail and things like that. I have decided that I will give you a pre-recorded session for some of, or in fact for the first part of our lecture, all the way up to this one, up to this case here, up to, I think up to here. Yep. Yes, slides number 25. I will give you the pre-recorded video later on, maybe by tomorrow or a day later. Let me check on. Let me update first. Okay, some of these issues are involving just a brief one very quickly. So I already mentioned that now we have to move into something deeper. Don't just look at income as stated in your P&L. Oh, income, just happily pick it up and put it into your tax computation. We have to know exactly whether the income is accessible in Malaysia or not. Income, yes, we know class of income. Yep, it's inside there, section 4. But exactly whether it will be taxed in Malaysia or not, that depends on whether it's derived here in Malaysia or not. Okay, so that is the concept that we use here in Malaysia. So that's why I've got some cases here, like for example, just one simple example, talking about, this is a very good case here, Penang Realty. Penang Realty is actually a property development company. Okay, so what happens is that, right, they dispose of, buying and selling land and also properties, right? Those are normal course of business of this company. But the problem is now, when I say that normal course of business means, right, the land owned by this company here basically is current asset or long-term asset or fixed asset. A property development company own land for future development, right? They will build, they will construct building on the land and then they will eventually sell all this off, right? So my question to you would be, how do you want to classify the land in the accounts of the company as current asset or fixed asset? Current asset, right, is WIP, if you ask me, raw materials, okay, no problem. The problem here is that this particular company was a bit unlucky. He was actually forced to sell, the company was actually forced to sell a piece of land, okay, not voluntarily, put it this way. Now we have Malaysia, we have our land, okay, acquisition land law here in Malaysia, which says that, right, if let's say you own a piece of land, the government think that this particular land is very important for strategical reason for future development of maybe a highway, okay, and your land is located right, okay, in the middle of this highway. What happens is that government can order you to sell your land, and you cannot say no. You cannot say no. But they say that they will pay you back in terms of market value lah. Okay, they will pay you back as in market value. But promise, I want to keep this land for future development. Like this company here, they have a piece of land. The government says that, oh, we need to actually take over this land here for some kind of a state-owned development. Okay, so problem here is that the company says, I do not want to sell this land. I want to keep this for my future development, of which I will make more money. So that's why the taxpayer here not willing to sell, but the government says you have to sell based on the market value of the vacant land, of which it will be much more lower than the future value of the land, correct or not? So that's why company say no, I'm not going to sell. Cannot say no because the government say acquisition, land compulsory acquisition, put it this way. So then what happened? Company was forced to actually sell the land to the government, and the next day, tax office sent them a bill asking them to pay tax. Why? Because they have disposed of a piece of land at market value, they make a gain. So they will have to pay tax, fair or not fair. Government force you to sell, next day the tax office wrong you. Fair or not fair? Not fair, isn't it? How can that happen, isn't it? Government force you to sell your land, which you want to keep it for future development, make more money. Too bad, you have to sell now. So because of that, the taxpayer put up a case against the tax office, taxpayer won the case. All the way to court of appeal. All the way to court of appeal. Okay, but the obviously tax office they don't like the decision from the judges, put it this way. Okay, so they have issued many statements saying that the judges were wrong and things like that. Contempt of court if you ask me, but too bad their tax office can say whatever they want to say, right? And they keep on losing many more cases, similar nature, until one fine day they cannot stand the humiliation anymore. What have they done? They changed the law. Yes, they changed the law. Unfair, isn't it? They added in section 4, capital C. That's why when you read the Income Tax Act, you see section 4 and then capital A, capital B, capital C, right? Okay, those are the results of taxpayer won the case. Most of the time, tax office lost the case, right? They lose the argument. They're not happy. They went to the parliament. They are in control of the parliament. They change the law. Yes, exactly. So these are the interesting things that happen. But to me, I think this is actually now. This is not the end of the story. Even after the change of the law, right? What happened was the latest development. Similar case again. Tax office use the same law. Now there's a new one, Section 4, capital C, right? To force the company sell and tax the company. The best part was this company brought the case all the way to federal court and said that right, this is a violation to the constitution. Yeah, very simple, because according to the constitution, right, we can keep our land as long as the land is actually, let's say we have got leasehold land and freehold land, for example. For leasehold land, you can keep that for 99 years. For freehold land, I can keep that forever. Okay, so it is okay for the government to have land acquisition, compulsory acquisition, no problem. But in terms of the value, how they're going to compensate you, right, becomes an issue here. In this case here, what happens is that the Article 13.2 of Federal Constitution says that, right, no law shall provide for the compulsory acquisition or use of property without adequate compensation. So the argument is adequate compensation. What is considered adequate? From the perspective of the tax office, I go and check the latest market value about this land here. The quantity surveyor, the valuer also tell me that, oh, this is actually 2 million, I pay you 2 million. But is that adequate? From the taxpayer perspective, is no, I keep this land, I develop it further, I make more money in 5 years' time. It is not 2 million. You get what I mean? So because of that, right, the tax office again lost the case, even after they've changed the law. So now it's up to, again, now I don't know what stunt they want to play now, because now apparently it's about, the constitution already. It is not something that you can change easily. Constitution means what? Two-third majority in the parliament to change it. They can't change it now. So they're scratching their head what to do now, I'm quite sure. Okay, so this is what I'm trying to tell you is that in law, in tax law specifically, right, the fun part of it is, okay, nothing is fixed forever. That's why if you look at the income tax law, right, some of the sections have already been deleted. Some of the sections just added in, like this one. Okay, why? Because after they lost the case, they will have some post-mortem, they will do something. Okay, some of the legislation which are too old, right, they will have to remove that. So that's exactly what happened in tax law. That is why to practice as a tax practitioner, they make lots of money if you're a good one. Okay, why? Because they play with all these things, the gray area. So just a recent case, the Keysight Technology, tax office was ordered to pay back together with all the penalty they have incurred, they have charged the taxpayer, and also interest owed to this particular taxpayer, 238 million. Yeah, a refund of tax plus all the penalty they have charged the taxpayer plus all the interest they're supposed to compensate against the taxpayer, 238 million. Can you imagine how much the tax consultant is going to make from this deal here? Serious, okay? So that's why if you're really good in tax, right, you can really, you can make a good living. That's why it is another option for you to consider, especially those who have done the audit, okay, in your internship, and then you come back, you still want to do audit? So it's up to you. I'm not going to judge. I'm not going to comment, right? So this is alternative for you. Okay, so the reason why I'm putting some of these cases here is to tell you that in tax, right, okay, the most challenging part is it is still fluid, still a lot of changes. Okay, and sometimes it depends on how you argue the case as well. Okay, that's the fun part of doing tax, and also the challenge of me teaching tax as well. You know why not? Because I work so hard to prepare all my materials, about this PA reality case. Suddenly this case came in and changed the entire thing now. Okay, so that's the challenge. So I will have a pre-recorded session for this. Don't worry. Okay, so you just listen to this one later on, and then what else I want to tell you? Okay, let me just focus. This is another one more. Okay, very interesting case. I have the pre-recorded session. Clear water sanctuary. Anyone from people? Yes. Have you seen? Have you been to this particular club or for your lunch or something like that? It's a golf club near Simpang Pulai. Okay, so they put up a case against the tax office, and the tax office lost the case. Eventually, they changed the law again. Something to do with service income. Okay, I will cover that in a pre-recorded session. Okay, let me cover this one here. In fact, I've written a book chapter specifically on this particular law that I'm so unhappy about. Yes, so this is a book published I used the grant from CT, Chartered Tax Institute of Malaysia, okay, to publish this particular chapter here talking about this particular issue. I was very pissed off with this particular new, the changes to the law. Never mind, so if you have the time to read again from. Now, let me move on to do the trading stocks here. So for slide number, I think number 2 all the way to number 25, but don't worry, I will have the pre-recorded session for you. Okay, I think this is the only one that I don't have the pre-recorded session is this one. This is the one I don't have, but it's okay. Just read this; it's very easy to follow. Just tell me that this is the latest development. Nothing. Okay. So let's see. Next year there might be another one more update over here. Okay. Let's move on to trading stocks. Okay. So why I want to focus on trading stocks, because trading stock is another one more area that has a lot of issues. When I say trading stocks, I'm not talking about the cheap stuff like the trading stock, the consumables in sundry shop, for example, or grocery shops. Okay, when I say trading shop here, I'm referring to those very expensive ones, like for example, properties, in the accounts of property developer. Okay, those things cost problem to the tax office. Okay, because we have companies out there, right? The directors or the shareholders, they're trying to siphon out all this very expensive stock in trade without paying income tax. So we need to have the measures to check on this. Okay, to counter this. So income from sale of stock is accessible under Section 4A, income from a business, very straightforward, no problem. Now, purchase of trading stock is thus deductible. So when you buy the stock in trade, you can claim a deduction under Section 33. Then you sell the stock in trade, right? No problem. Then you have income. You have to do the matching there. It's a bit like what we have done in accounting. Matching process is very straightforward. You have your income, then you can claim the deduction. Without the income, there's no point for you to claim the deduction. Put it this way. Okay, bear in mind that the test that you have to go through is wholly and exclusively incurred in the production of income. Okay, so that is actually very important, section 33. Yeah? Okay, and it's not a capital item like capital asset, qualifying asset for CA, capital allowances. Those will be restricted under section 39. Okay, this is what you have done right in your MTS. If you buy an asset, a machine, can you claim a deduction under section 33? The answer is no. Why? Because section 39 says so. You cannot claim. Then what can you claim? You claim CA, capital allowance. It's a bit like depreciation. Okay, it's a bit like depreciation, but the way we calculate will be slightly different. CA is very straightforward, straight line method. Straightforward. Okay. Then we have now opening and closing stock accounted for under section 35. This is the sections that that we use to deal with all the stock in trade. Okay, so we have got a section 2 here that talking about definition. If you refer to section 2, you will see all the definitions over there. Anyone coming in? Haunted. Almost 7 something already. So if you refer to the Income Tax Act section 2, right? Okay, I'm not afraid of that. Okay. So if you refer to section 2 of the Income Tax Act, right, you see all the definitions that we use in our income tax law. So including this one here, what is stock in trade, for example, means property of any description, whether movable or immovable. So in essence, it's very simple. This is very similar to what you have done in accounting. Okay, stock in trade you consist of finished goods and also the work in progress and the raw materials as well. Okay, exactly like what we have learned in accounting. It's quite straightforward. Okay, okay here now there must be a business which involves the manufacture, sale, or exchange of property of that kind. Item must be held. Okay, this is just a summary of what I said just now. We're talking about items we use in the course of normal business. Okay, it's very straightforward. Now here, I specifically put in this particular slide here. We're talking about now. This is the one that having problem here. Properties, very expensive stock in trade. Okay, so what about the owner-occupied property, for example? Now, if you are in the business of property development or construction, you build some let's say residential properties, right? Okay, but you use one of this unit for your private residential, for your own residential use. In that case, right, this particular one unit is more a stock in trade, but others are considered stock in trade. So we have to be very mindful because when you dispose of these properties, right, if you have disposed of the stock in trade, you pay income tax. But when you dispose of a piece of property which is owners occupied, or means you as owners, right, as your own residential property, you don't pay income tax, but you pay real property gains tax, different one. But it's much more cheaper as compared to income tax. Because income tax, the tax rate is 24%. Okay, for a normal company with capital more than 2.5 million, 25, 24%, eventually 23%, and the trend is going downward. Okay, the trend is actually going downward because other parts of the region, right, like our neighboring countries, they are also reducing their tax rate as well. So to stay competitive, we are also in trend of moving, of reducing our tax rate here in Malaysia as well. Okay, but it's a fixed rate. It's either like 23, 24%, right? If you're a company with more than 2.5 million of working capital. But in terms of RBGT, is different. RBGT is the tax rate will be based on the holding period. The longer the holding period of the property, the lower the tax rate. So if you, let's say you are a property developer, you own a piece of property for your own residential, okay, for your own family use, right? So when you dispose of this property, it will not be considered as disposal of stock in trade, it will be considered as disposal of a normal property, which will have to pay RBGT. So if you have stayed in this property for more than 10 years, for example, the RBGT rate is zero. No need, okay, no need to pay tax. Okay, so that's why it's very important. The classification of the properties is very important. Whether it's a stock in trade or is a private property or office occupied property. Okay. See. Okay, so these are the subsections here talking about the opening and closing stock value in a basis period. Okay, to ascertain the adjusted income formula to compute cost and gain of sales. So in all this section 35.1 and 35.2, right, very similar to what we have learned in accounting. Okay, so we are using the cost method in order to calculate the cost of goods sold and also the value of your closing stock. Very straightforward one. Okay, we can use FIFO, no problem, average value, but we cannot use LIFO. We cannot use LIFO. LIFO is, now the law didn't say that you cannot use LIFO, but in a public ruling issued by the government or the tax office, they say that you're not supposed to use LIFO. It's up to you if you want to challenge them. Because the law didn't say LIFO cannot be used, right? So the law does say that you use cost method. Cost method could be LIFO, could be FIFO, could be average cost, right? But tax office Monday came up with this guideline and says that you better don't use LIFO. If you're not happy with them, you challenge them, okay, fine. It's up to you. Okay? So why LIFO is not welcome here in Malaysia? Any reason? You've learned this in your accounting. For the same reason. Did your lecturer in financial accounting say something about that? Why you cannot use LIFO? Yes. Okay, yes. LIFO will tend to overstate your stock, your closing stock, right? So if your closing stock being overstated, what happened to your profit? What do you think? Sorry, LIFO is not overstating. No, hang on, concept wrong already. LIFO, what happened to LIFO? LIFO is last in, first out, right? That means all the expensive, now based on the theory of inflation, so all the expensive stock will go up first. Then what left in the closing stock would be based on earlier price. Earlier price means lower. Okay, understate the closing stock. When you understate the closing stock, you overstate your cost of sales and therefore you understate your profit. Okay, that's a problem. Okay, LIFO means last in first out. Whatever more expensive comes in, right, you sell first. The assumption is you sell first. And then what left in the closing stock will be those cheaper stock because of inflation. You got what I mean? And therefore, okay, what happens to your cost of goods sold? You're overstating it, therefore you are understating your profit. And therefore you're not paying enough tax according to the tax officer. Okay, so that is why LIFO is not allowed. But again, it's up to you to challenge this. I'm not going to say anything. Now, stocks can be valued at lower the cost or market value, as I said, cost or market value. Now, another one more thing is that if you have checked the stock and you really can prove that the stock has devalued, okay, so much. In that case, can you actually use a lower stock value, lower than your purchase price, okay, lower than what do you call that? Of course, the normal market value because of obsolescence, for example. okay, let's say some damage to your stock, and because of that, right, okay, it's no longer market value at all. Okay, it could be much more lower than the market value, even lower than the original cost. Can you actually use a lower cost or not? The answer is yes, provided you have the evidence, the documentary evidence to support that. So that's why some of these big organizations, right, they will actually get their auditors to come in, the valuer to come in to look at their closing stock to ascertain the value so that they can use it for their tax purposes as well. Okay, so it's perfectly okay. Lower the cost of net realizable value, the same mechanism or the same concept we use in accounting. Okay, and also another one more thing is market value as in arm's length. Okay, arm's length. So what is arm's length? Means must be logical. You cannot have a piece of stock, right? The original price, this original cost is 100,000. And then when you come to evaluation, you see 10 ringgit. Cannot lah, right? Arm's length. Arm's length means what? I know it will be maybe lower than 100,000, maybe 90 or 85,000, right? Something that arm's length means something that you can, let's say for example, you dispose it of, somebody will actually buy it. External party will come in and try to buy this particular stock, and you can shake hand, done deal. That's why I call arm's length. Okay, something logical. Cannot be 100,000, then you value as 10 ringgit, as I said. Okay, and also cost method, as I said, FIFO and LIFO. LIFO is disallowed under Public Ruling 4216. Nobody challenged it yet. You know why? Because inflation is not a problem, Malaysia. If inflation is a really big problem here, right, there will be companies using LIFO to do their accounts. Then the problem will come. But fortunately, so far we have inflation, but not very massive like what happened to some of these Latin American countries and also some African countries. We are lucky, okay? I'm not so sure how much longer we be so lucky lah. How many years? Okay, now, so then the tax treatments here, provision of obsolescence as usual. Okay, as I said, if you really, okay, notice that some of your stock you trade, right, damaged, okay, because of flood or something, right, something happened, mishandling, things like that, you can actually use a lower value to value your closing stock, no problem, as long as you can prove that. But if you want to make a mere provision as in to pluck the figure from the air, that's it. Okay, it's a bit like provision for bad debts. Can you claim deduction for provision for that of bad debts? You can't, right? It's a provision, accounting provision, you can't. But can you write off a real bad debts or not? You have a specific provision, isn't it? Under section 34, correct or not? Specific provision as in you have all the evidence to show that the debt has already gone back. Like, the debtor may be already gone bankrupt, or maybe the debtor already passed away, unfortunately. So if that is the case, right, you can write off, no problem. You claim a deduction. That is perfectly okay. But if it's a mere provision, you can't do that. Okay? So, and then we have to use matching principle as well. Now, this one here is a very awkward one, section 35(3)(b). Value of opening stock on hand is the same value as last year's closing stock on hand. Isn't this logic, right? Common sense, right? But how come we have a section here, section 35(3)(b) here, to specifically say that, okay, your opening stock value must be the same with last year's closing stock value? I thought this one is common sense. You know why? Because we have got some creative taxpayers, right? The challenges. Without this, right? Don't be surprised that you have closing stock and also closing stock last year and also opening stock different figure. Yes, the case actually happened in Australia. There was a case happening in Australia, very, very smart taxpayer. Because at that point in time, many years ago, right, it was more specifically mentioned in Australia, saying that last year's closing stock value must be the same with opening stock the next or the succeeding financial year. So the taxpayer play around with that to try to maximize the tax position. Okay, so the tax office no choice, they add in this. So Malaysia also added in into our tax legislation. Sounds a bit awkward, but okay, you have to be very mindful when you deal with all these very creative tax cases. I've seen very creative tax cases I will share with you when I do tax avoidance and tax evasion. Okay, let's go through some. Okay, this one here is very important. Okay, why? Because we have got some, very awkward, as I said, some very creative, tax figures that they're trying to play around this. Okay, the gray area of in our tax legislation here. Appropriation of long-term assets and trading stocks can be problematic. Means what? You are trying to change, okay, the characteristic of your assets from long term to current asset. this will trigger tax implication. Why? Because if you're holding a piece of fixed asset, you dispose of the fixed asset. If this asset has not been used in business, right, nothing. The gain will not be taxed here. The disposal gain will not be taxed in Malaysia because we do not have capital gain tax on disposal of, for example, machine and things like that. We don't have that. We only have capital gains tax on disposal of privately owned shares. Okay, private company shares. But okay, if you're talking about normal, okay, let's say you have a piece of machine, you dispose that off. What happened? Will the gain be subject to tax? The answer is no. But if the machine has been used for business, right, it will trigger balancing adjustment, as in balancing charge or balancing allowance. But strictly speaking, balancing charge is not a gain on disposal. Okay, I will explain to you later on when I talk about that. Okay, but the most important thing here is that, okay, I'm trying to highlight to you, if you try to change or try to move your long-term asset from the balance sheet into stock in trade, current asset, right, that can be problematic. In this case here, DGIR versus DGIR as in Director General of Inland Revenue versus LCW. This is the case involving in the business, okay, the taxpayer in the business of timber and rubber plantation. We are talking about plantation company. Initially, acquired a piece of land worth 20,000 long time ago as long-term asset, plan to build flats for renting. So the idea is the taxpayer wants to keep this piece of property for long-term investment, and then you build some, what do you call it, flats, okay, some high-rise buildings there for renting purposes, not for disposal, not for sale. So strictly speaking, the land should be classified as a long-term asset. No problem. Now, 10 years later, taxpayer ventured into property development business, reclassified to stock. So when the company venture into property development, they have reclassified this long-term asset into stock in trade. Why? Because officially they have changed the business focus from plantation to property development. So that means, right, the land bank has got a totally different classification. The land owned by this company will change in terms of the characteristics. That is very important. So then what happened? Now, the company revalued the land to 480,000. Can you imagine? From 30,000 to 480,000. Market value on the same day. So on the day they changed the business, they revalued this particular land, used to be 20,000, and then eventually becomes 480,000 and capture that accordingly into their balance sheet. Okay? So this case happened before 1976. Because if it happens after 1976, there shouldn't be any problem. But now, okay, the case happened before 1976. So what happened to this? Tax office contended as revaluation will significantly reduce the profit from taxpayers' property development business and thus ordered taxpayers to value the land on cost. Do you know why? Now, a bit difficult for you to understand, but if you read the textbook or you read the case and the facts of the case, it's difficult to understand. Let me show you the diagram. The diagram will explain everything why, then you will know exactly why the tax office is so pissed off. Now, this is what happened. 1960s, early 1970s. The LCW was a plantation company, bought a piece of land. Okay, this one investment asset 20,000 lah. Okay, and then eventually in early 70s, right, the company from plantation becomes a property developer, and then they have revalued. Okay, they have revalued the asset, and the land becomes 400. How much? 480,000. Okay, 480,000 here. Okay, becomes stock in trade. So eventually, later on, in the open market, they can sell the properties at Z market value here. Okay, very expensive eventually. Now, my question to you would be, why the tax office is so unhappy about it? Why the tax office is so unhappy about it? Let's look at this one here and know why the tax office is so unhappy about this. Now, you look at the taxpayer here. Okay, eventual sale of the completed properties, assuming that the taxpayer managed to sell the properties together with the land. Okay, the land acquired many years ago, right, at R value here. Okay, now as a property developer, you look at the P&L, you see this, the cost of construction, the labor cost, the material cost, and the overhead, everything. I put L, M, and O. I have no idea what would be the figure, no problem, just illustration only. And then the land cost, now the land comes with cost, isn't it? The taxpayer put that as a property developer, the land cost is 480,000. Why 480,000? Because when they move from plantation to become a property developer, okay, they assume that they have bought this particular land from a plantation company. They're buying the land from themselves. You get what I mean? at 480,000. And therefore, okay, the profit calculated here is X amount. Okay, then I will say no. The cost, okay, the cost of this land should be stated at historical cost at 20,000. The argument is back to section 35. Okay, it says that. Okay, never mind. I'll go through the section with you later on now. Okay, it should be stated at cost. 20,000, lower the cost. Okay, lower the cost or net realizable value, whichever lower. So it should be 20,000 here. I have no idea what is the value of Y here, but one thing for sure, Y is bigger than X, correct or not? So if you are tax office, which one do you want? Y. That's simple. That's the whole idea. That's the whole idea. Tax office is not happy. Say why? You know, again, it has to be stated at historical cost because the law must say that it must be stated at cost or net realizable value. So, or something lower. Okay. So therefore, it should be 20,000 here. This was actually the entire argument here is about whether it's 480,000 or 20,000 here. So who won the case? The taxpayer won the case. Why? The taxpayer has got a very good tax lawyer. I'm very sure. Okay, so what would be the contention here? Okay, let's look at this one up. Now, section 35 A1 and 2 here. Stock to be valued at lower the cost or market value. Whichever lower, whichever lower. So the interpretation of cost, that is where they argue. Okay, now the taxpayer perspective, now let's look at the not so smart perspective first. Cost means the historical original cost incurred by LCW 10 years ago, 20,000. Hence, when the principal or lower the cost of MV is applied, LCW should value the stock at 20,000. That's the argument. But the tax lawyer representing LCW very smart. They say we have got two different LCWs here. One was actually a plantation company. The other one is a property development company. Okay, so the 20,000 was actually the cost incurred by the LCW plantation, not by the property development. Very smart, isn't it? Very smart, I tell you. Okay, so here the taxpayer's perspective on the date of conversion. Seller LCW plantation company disposed of an investment asset. Sorry, I hope. An investment asset. Okay, and buyer LCW property developer. They're selling to themselves. Very smart, isn't it? Purchase a stock. Clearly documented in all the minutes of meeting, with the board of directors and things like that. And change of the purpose of subject matter due to change of business venture. Yes, plantation, property developer, I don't see any connection there. Okay? So two different business segments put it this way. Now the deemed sales price based on market value 480,000. That means on the day of conversion, right, the LCW property developer has acquired the land from LCW plantation at 480,000. And therefore, the cost incurred by LCW property developer is 480,000, not 20,000. That's the argument. Smart, right? And he won the case. They won the case. Okay? Okay. So, what happened to, okay, if you look at 480,000 minus 20,000, right, there's a gain of 460,000, isn't it? Okay, this gain made by whom? LCW plantation. Any tax or not? No income tax. Why? Because they're not in the business society. Number two, the case happened in 1972. Real property gains tax came into the picture in 1976. No real property gains tax as well. Okay, that's why if you manage to see things like this, right, and practice as a tax consultant, right, it'll be very scary. The tax office will probably send someone to murder you. Okay, I don't know. This is exactly what happened. Okay, this is exactly a very smart case here. This is a very smart argument used by them. So obviously the court, okay, concurred with LCW's interpretation. Okay, and says that, right? Okay, too bad. Okay, deemed to have acquired the stock at 480,000. The cost incurred by the property developer is actually 480,000. The 20,000 was actually incurred by LCW plantation, and it was actually a capital gain that is not subjected to any income tax at that point in time, and also RBTT as well. Understand? Okay, this is the interesting part of seeing all these things here. Next case here, so I'm going to explain. So far, any questions? Any questions so far? Am I clear? Yeah, okay, good. So we have got another one more case here, very similar nature, very similar. Mount Pleasure Corporation versus KPHDA. KPHDA is DGIR. KPHDA means in Malay, Ketua Pengarah Hasil Dalam Negeri. DGIL means Director General of Inland Revenue. Okay, the same thing. Now, similar facts to LCW case here, the only thing that is different was, what happened was, this company, Mount Pleasure Corporation, right, since day one, the company was actually in property development. That means, right, a piece of land they own, right, is not investment asset. It was stock in trade since day one. They tried to use the same facts as for LCW, they lost the case. Okay? Next, their company acquired land claims to be investment 1971. Okay? We classified the land into trading stock in 1979, 79 at market value. So after the enforcement of RBGT, so they actually capture that as a market value. Okay, when they reclassify that. So they are thinking that after if I reclassify that, right, that means eventually I dispose of this land, I will have to pay RBGT, not income tax anymore, which is actually much more lower. They thought so lah, because RBGT came into 1976, came to force 1976. So they thought that, oh, now I actually change, I convert this land, from investment into stock in trade here, again in 1976 based on market value. And they're happily paying their RBGT. They're paying their RBGT happily. Oh, RBGT, I have owned this land like more than 20 years already. So back in 19, okay, they bought this in 1971, right? Up to 79, here is about 8 years difference. So those days, right, if you dispose of a piece of land more than 5 years, right, for company it was only 5%. 5% gain, get 5% tax on the gain. Okay, but if it's a normal corporate tax, back then I think it's about 30%, if I remember correctly. So in that case, they thought that they were very smart, but the problem here is that they have some problem now with this company. Okay, why? High Court look at this case here, and they found all these facts here. Okay, since 1971, that particular land was actually trading stock. Why? Because taxpayer failed to provide any evidence for investment purpose. They cannot show any proof, like board of directors meeting, or they have do some filing with the registrar of company saying that that piece of land was actually investment property. And then, taxpayer has been dealing in properties. That means, right, they are already in the business of property, selling and buying, property trading since 1970, 10 years ago already. So they cannot argue that they are changing their business focus or their business venture. No, they cannot. It's not like LCW. And the best part is, taxpayers M&A. You know what is M&A now? Memorandum and Articles of Association. It is now called the Constitution. The Constitution. Okay, so what is inside the Constitution? We've learned this in the company's law, right? So what are those things stated in the Constitution? Things that the company can do, things the company cannot do, and so on and so forth, right? And the principal activities and things like that, right? So in the M&A of this company, never mentioned that they can hold land for investment purpose. So that means the land they acquired was actually entirely for resale, that means for trading, okay, not for investment purpose. Okay, and therefore they lost the case. This will be a major difference between LCW and also Mount Pleasure. So that's why a small little things that is different, right? Small little thing that is different, right? Can change the entire judgment. Okay? So this is what we have to be very mindful. That's why in the exam as well, I give you tutorial questions, you practice, practice, practice. Okay, I can actually copy and paste the same questions into the final exam and change a few words there. Maybe just 3 words, next treatment all change already. Then you go out, if you just memorize and try to, output back whatever I give to you, right? Then you have problem. So be very mindful, this. Next. Okay, now I talk about change of asset from fixed asset to stock in trade, current assets, right? What happens if, we have another scenario, another transaction here talking about change of stock in trade into fixed asset. Opposite of what happened in the LCW. It is called withdrawal of stock in trade, put it this way. Okay, this is what technically withdrawing your stock in trade. Let's say you build properties, you build 10 units of shop lots, and then you retain 1 unit for your own use to house your business. In that case, right, you are changing the characteristics of your stock in trade into a long-term asset. So in that case, right, what happened then? Section 24(3)(a) will come into the picture. So we have got this coverage here as a gift, contingent property, exchange with combination of property, and also cessation of business. I will cover this later on, no problem. Okay, and this one as a gift, contingent property, and exchange one, I don't think so. I will cover. If you want to read more, you can go to the textbook or you go to the internet and find out more. I just want to cover this one. This one because this one was more problem with the tax office. So I cover this. Section 24(2)(a) here. So what happened? Okay, we're talking about conversion of stock in trade into fixed asset. Okay, so what will be the problem? Okay, let me show you now. Stock withdrawn for own use here. Governed by Section 24(2)(a), deemed sale of stock at market value, gross business income subject to tax, all this blah blah blah. Very difficult to understand, but simple. Assuming that you own a grocery shop or sundry shop, you sell canned food in a sundry shop, things like that, right? So imagine one fine day, right? You take one pack of Maggi from the rack, bring back home, cook that, and you eat that eventually. You consume that particular product eventually. What happened to your business entity? How your business entity should account for that? From accounting is drawing lah, but from tax is too bad, not so simple. It's not that, oh, I take back home, just eat lah or what, so big deal. From tax perspective, under Section 24, it says that, right, if you have done this, you take one bag of Maggi from the shop, go back home and cook, right, your business entity is deemed to have disposed of that Maggi at market value. You're supposed to pay tax. Your business entity is supposed to pay tax. Because that one is, okay, that withdrawal is considered as deemed disposal at market value. That means your business entity will have to have a sale figure that based on market value of the Maggi. And then can you claim the cost of the Maggi because you bought that from the supplier, isn't it? Can, no problem. Section 33 allows you to actually claim the deduction, but it will create a profit there, and the profit is not realized. You know what's the unrealized profit or not? You never earn this profit money. Okay, but you still have to pay tax for that. Fair or not fair? My question to you would be, do you think you will be so honest to tell the tax office, actually I bought some Maggi and sardine back home? Do you think you'll do that? No, isn't it? We know, again, in practice, practically speaking, right, it's actually not practical to have this section here. For, again, those small little traders, okay? But the tax office has already explained. They said, we asked the question, we asked the tax office. Many years ago, we asked the tax office, why do we need to have this one here? Because in Australia, okay, the deemed disposal will be based on cost, not based on market value. That means you have cost as disposal value, and then you claim a deduction for the cost. That means it will neutralize. You become zero profit left. You don't pay tax. Okay, that was what happened in Australia. They probably have regretted that. I'm not so sure whether they achieved or not. You know why this is actually important or not? The tax office explained, they say, no. This particular section is not aiming at all those small local stock in trade, okay, like all the Maggi and sardine in your grocery shops. Okay, this particular section is needed to check on all those very expensive stock in trade, like for example, properties. Imagine if this law is not here, what happened then? The shareholders of this property development company can simply take properties from their company without paying tax. Okay? Because if this particular law is not enforced, right, okay, the owners of these property development companies can just simply take whatever they want from the company's account and they don't pay tax. They can simply like, oh, okay, I take one unit of office unit from my company, and because of this law is not enforced, then the company don't have to pay tax. After I've changed the name, I've changed the ownership of this property from a company to myself, I dispose of, I pay RBGT, do property gain tax, I don't pay income tax, much more lower. You get what I mean? Now this becomes an issue. Okay, tax avoidance issue. So in order to mitigate this problem, right, IRB says that right, this law is needed as anti-avoidance measure. This law is to tackle the issue of owner of business entity siphoning. Siphoning, I use the word siphoning, that means they pick up one more expensive asset from the business entity for their own use without paying income tax. That is why this is very important. So, and because of that, we have some cases here, Marco development. A benchmark case here. So what happened to this case here? So we're talking about taxpayer company with principal activities in property development, build shop lots for sale and retain one unit for own office use. Exactly like what I mentioned just now. You can do that, no problem. Okay? Business decision, you can do that. But from tax perspective, you have to be very mindful. After the completion of the shop lots, own office lot was reclassified as fixed asset and cost from trading stock. So that means what have they done? Well, when they built this shop lots, right, Okay, how do they account for this in their accounting records? Do they put this particular short loss, right, as in current asset or fixed asset? Current asset, right? You've done this, right? Accounting for contract. Okay, you put it as WIP or contract in progress first. And then eventually, after the completion, okay, one unit of this particular short lot, right, reclassified. That means they have credited their WIP account and debit into their fixed asset account at cost. Whatever money spent on this particular property, that's all. That's it. They didn't go through the process of revaluation. Okay, so the lot was eventually disposed of and next year declared RBGT instead of business income. So many years later, okay, they finally dispose of this particular office unit. They don't want to use this anymore. So they dispose of and then they declare. And then they want to pay for RBGT, new property gains tax, and after 5 years already. So the tax rate was actually close to zero, for 5% only. So do you think a tax office will be happy with that? No. Why? Very simple. The question is whether this particular property has been converted successfully or not. Whether this particular property has been converted successfully or not. What does the law say? 24(2)(a). This is a case of withdrawal for own use, isn't it? Okay, in that case, market value must be used. Why? Because when the company converts this stock and trade into fixed asset, right, it's actually property withdrawn for own use. In that case, what happens? This will be considered as a disposal of stock in trade in the accounts of the company and clean deduction for the construction cost. It will be unrealized profit, okay, in the accounts of the company. And these unrealized profits must be taxed. Okay, must be taxed. And the company needs to start. So in that case, right, the company cannot treat this particular property as a long-term asset where they dispose of eventually, many years later. They will have to pay for income tax, not RBGT. That was what happened in this particular case here. Okay, so the court upheld the tax office decision. Application of section 24(2)(a) requires reclassification of stock into asset based on market value. Okay, so in other words, if you want to convert a stock and trade into long-term asset, right, you have to go through the process properly. Okay, at the point of conversion, make sure that you capture that in your accounts. Okay, the sales revenue must be based on market value verified by some private valuer or something like that. And then no problem. After that, you tax accordingly. Okay, pay tax accordingly. Then, if your conversion is successful, then many years later, when you dispose of this particular unit finally, right, you are deemed to have disposed of a long-term asset that actually RBC not tax anymore. Okay, so that's exactly what I'm trying to. This is part of tax planning. Okay, because we have got a lot of companies out there. I'll share the use of tax planning later, property developers. Okay, so this is I summarize to you what are the things that we're supposed to be mindful of when we are changing our investment property to stock and trade and vice versa, based on the cases that we have in Malaysia here. Questions? Yep. And cost. The real cost. Tax. Yes. And the best part is in the future, when we have e-invoicing, right, this becomes even worse. Why? Because basically, when you withdraw the goods from your what is called your business entity, right, should be supposed to invoice yourself. Something like that. The tax office at the moment say, oh no, we're not going to do this. Why? Because small business entities are okay, you know. But in the future, if they notice that some people actually siphoning out, big assets, so the e-invoicing process will come with. Don't worry, I've attended quite a number of e-invoicing courses already. It's not difficult actually. It is not difficult. Something that software can resolve. It's just that you probably need more people to do the data entry. That means you create more jobs for you. Questions? No? Okay, good. Okay, so with that, right, lecture 2, as I said, the first part, I will cover that using a pre-recorded slides for you, okay? So that to keep you awake. Now I need to cover this question so that we have a clearer picture when we deal with withholding tax. Withholding tax. Yes, I told you already, right? You want your additional exemption, okay? No pain, no gain, okay? No, I'm preparing you for that. I try to speed up the lecture as soon as possible so that we have more time at the end of the semester, right? I will prep you for your exams. I need to do that because no joke. The final exam is going to be challenging. Yes. Is it still within your ad hoc period? So you can reconsider your decision. It's still not too late to actually take the job I just
没有，他
kidding.
讲他读到凌晨5点，然后他都拿3.25个，跟他讲一下嘛。哦，好像这样，每
Okay,
天
so
考
let's
试
go
的
through
时
this
候，
question to have a clear
之前的
picture
时候，
of why derivation section is very
上
important.
课的时候，他
Okay,
讲啊，
I know this is
他
our
朋友也
first
是
time
弄
we're
完
having a
毕业，
class until 8, but
也是读到凌晨
let's see
3点，
whether I can finish earlier or not. Okay, I know. It's not very
他是拿
healthy to say.
3.25。
Tomorrow I have 3
他没有，
classes
他
or
都
4
没有
classes.
要
Never mind.
job。
Okay, let's look at question 2 here. Now I've covered the interest question here. Now I'll cover royalty. Okay, why this question is very important because it will actually help to build your understanding when we do read tax, right? This is actually very important. Now we've got this company here. Elephant is a Malaysian resident company which is required to pay a royalty of 6% of its annual sales to Reddit. An Australian company for the use of patent. So the royalty payment here is 6% of the sales. So royalty payment normally it will fluctuate. Okay, royalty payment will fluctuate normally. Okay, in tandem with the sales here, for example. So royalty is not a fixed amount. If it is a fixed amount, then it becomes rental. You get what I mean? Now, if you use a property, okay, intellectual property, if you use an intellectual property and you have to pay a fixed amount, right? I will say that one is actually a rental. Okay, when you use an intellectual property to use something, and the royalty is based on the amount of profit you're going to make from the use of this intellectual property, right? Then it becomes royalty in nature because it will fluctuate in tandem with the sales revenue and the profit that you make. So in this case here we have royalty here. Now, Elephant also maintains a manufacturing plant in Uganda. Royalty is also payable on the sales of the products manufactured by the Uganda plant covering the domestic market there. Okay, so in that case, now again, I'd like to summarize things like this for you. You can snap photo. In my session, you can do recording. You can record my voice, no problem. You can snap photo, no restriction. I try not to use dirty words in
这
my
是谈
session.
话的。我建议你们呢，如
I'm
果你
okay
们
with
不
that.
要，你们不要也是
Okay
可
with
以，
that.
你们可以
I
看
notice
我
that some of
的
you
讲话
you want my voice, you want your voice recording to be your invasion method of
题目都一样了。
no restriction in my class. Okay, you can bring me your dinner
应
here
该谢
also.
谢我，
Okay,
应该谢谢他。
I'm okay. Just share lah.
没有，就是一样，就是一样。
Don't bring durian in. That's all.
这抽象哦。
Okay, so this is exactly what I'm going to summarize this using this particular diagram. Yeah, elephant, rabbit. So elephant must pay royalty, okay, to rabbit here for the use of intellectual property. Again, based on 6% of the sales revenue. So royalty 1 and royalty 2. Why royalty 1, royalty 2? Because royalty 1 will be used, so it will be paid by elephant for the use of the intellectual property in Malaysia. And the same intellectual property will be used in Uganda as well. There's a plant that unincorporated in Uganda. So this plant here is not a company, it's just a plant. It is a factory over there, managed by Elephant here. And okay, this plant here will also use the intellectual property, and therefore Elephant will pay royalty to Rabbit. So there are two different royalties here. So we go through one by one. The question is very short, but the technical content again is a lot. The technical content is again a lot. So again, if you look at so now, never mind. Before that, just revisit, try to remember what we have learned in section 4, right? We have classes of income 4A, 4B, 4C, 4D, right? So this is actually a 4D income, royalty income. 4D income. So the question here is, will royalty 1 and 2 subject to tax here in Malaysia? Now, simple. For elephant, the royalty payment is actually a form of expense. You agree with me now? It's a form of expense paid by elephant, right? You agree? Now, some say that it's actually capital in nature. They thought that a royalty is to pay for the asset, to buy the intellectual property. No. Royalty is to use the intellectual property, not to buy the intellectual property. If the payment is to acquire the intellectual property, then it becomes capital in nature and therefore it will not be given any deduction. Section 39 will restrict that. But in this case here, it's not. It's like rent. It's actually similar to rental, like you ask me, for the use of this intellectual property. So in that case, right, in the accounts of Elephant, accounting point of view, it should be expense. Loyalty 1 and Loyalty 2 here should be expense. So in the accounts of the Australian company Rabbit, right, it will be considered as income in nature. So again, when you say income or tax office will be very interested. Why? They want to find out whether you pay tax or not. So in this case here, can your Loyalty 1 be subjected to tax or not? Okay? Because Elephant will have to pay to Rabbit, isn't it? So will this amount be subjected to income tax in Malaysia or not? Let's look at Loyalty 1. So again, based on the same concept, income derived from or accrued in Malaysia will be taxed in Malaysia. This is what we do here in Malaysia. Source basis, we call it. Okay, derivation basis. So that means if you're earning, let's say, a Malaysian tax resident and also Malaysian citizen as well. Now you have to understand, citizen and tax resident, two different things. Are you clear about this? You have already done your MTS, right? To qualify as a tax resident in Malaysia, that will be section 7. What will be the general condition? Tell me. Yes, 182 days you stay here in Malaysia, then you become a tax resident. You might be an Australian or Singaporean in terms of the citizenship. But if you stay here for long enough, right, 182 days, right, okay, you're a tax resident here. Okay, so that's the difference. So now in terms of, okay, what do you call that, tax resident status? Okay, so in that case, right, we want to find out exactly, okay, now the company, the question only say that, the question already said that Rabbit is not a tax resident company in Malaysia. Now, to qualify as a tax resident for company, the section is different, section 8, of which I'm not so sure MTS is covered or not. But right, I will cover that section 8. It's a slightly different test because we cannot use a 182 days benchmark again for a company. For people, no problem. Okay? For company, different. We use the test of control, of which I'll cover that later on. So as I said, as a resident individual, right? So no problem. 182 days is the benchmark. So in Malaysia, what happens is, even if you are tax resident in Malaysia, let's say you, Singaporean, came to Malaysia, 200 days over here in Malaysia for 1 year, you are tax resident in Malaysia. Do you have to pay tax in Malaysia or not? You have to pay tax in Malaysia? If you earn income in Malaysia. If you don't earn income in Malaysia, you need to pay tax. Let's say you earn all your income right coming from Singapore, you never send the money back here in Malaysia, that's it, you don't need to pay tax, don't worry about that. So this is the basis that we use here in Malaysia. But in some other countries are different. Like for example, Australia. Australia pays, they tax their people based on a resident basis. Means right, the moment you become a tax resident of Australia, you need not to be a citizen there. Okay, you're just a tax resident over there. You will have to pay tax on raw income basis. That means everywhere you pay tax for whatever income you earn in Australia. You pay tax on whatever income you earn from the other universe. Also, you have to pay tax in Australia if you are tax resident there. So that's why to become a permanent resident in Australia, okay, it's very difficult now. It's not easy. Okay, they have a very strict immigration rules now. But to become a tax resident in Australia is damn easy. Really. Seriously. You probably just need a girlfriend or boyfriend there. Really? Why? Because okay, the first test they use, whether you are tax resident in Australia or not, right? They use the test of, we call it test of place of abode. What is place of abode? Place of living. Yes, so it means you have a girlfriend there in Australia, you spend the holidays over there. Oh, you stay there in Australia happily, right? Tax resident. Then whatever salary you earn in Malaysia, pay tax in Australia. Yes. But when you ask them, then can I apply to become a PR there or not? I want to enjoy all the perks and benefits of Australia. No, cannot. Not so easy. You get what I mean? So that's exactly what happened. So you have to be very mindful, okay? So it's totally different. So in this case, we have got Australia now. This is a company, so the tax the tax resident status will be determined by, we call it control test of control, which I'll cover later on. Never mind. Okay. Back to our question here. Royalty 1 is actually earned by Rabbit, right? So this is an income. The question is, can Malaysia Tax Authority tax on it or not? So we go through the same process like what I mentioned this morning, not this afternoon. Look at the derivation, whether the royalty income is derived from Malaysia or not. Okay, go back to section 15. Because section 15 is a general section, right, to deal with royalty and interest together. both. Okay, look at this one.